and welcome to Jane's LME Addiction, a Cloud 9 Fin podcast where we talk about the world of liability management. I'm your host, Jane Komsky, the head of LMEs here at 9 Fin, and with me today is Jon Henes, founder and CEO of C Street Advisory Group, and George Klidonas, a partner at Latham Watkins Restructuring and Special Situations Group. Thank you guys for joining me today.
Thanks for having us. Excited to be here.
Great. I'd love to just dive into your roles in this space. I guess I'll start with you, Jon.
Sure. So I know, as you know, and George knows because we work together a lot, I was a lawyer for 25 years, 20 years at Kirkland & Ellis, started C Street Advisory Group, which is a strategic communications and crisis management firm. A bunch of what we do focuses in the financial restructuring space. Back in February of 23, we started an LME communications group, I think the first of its kind. And we've worked on all different types of LMEs, helping with everything from media management to key stakeholder communications to limited partner communications, and really helping the lawyers and the sponsors and the company make sure that the media, you guys, get it right. You guys always get it right. And
that's exactly right.
You see that? Especially you.
Thank you.
And we, but it's a really important role, and something that when I was at Kirkland, I didn't necessarily see a lot of people who had the expertise, like the lawyers, the bankers, and the financial advisors. In fact, a lot of the media had, I think, more expertise than the communications firms actually did. And so we thought there was an opportunity to step in and really change the game a bit, which you can ask George now if we've done that or not, but I paid him, so he has to say we did.
Yeah. So George, I'll turn to you. Tell me a little bit about your role in the space and how you feel about Jon.
So I'm a restructuring partner at Latham Watkins. Our group is restructuring and special situations. And obviously that spans kind of the spectrum of what phase we come into the process. I think we'll talk a little bit later about what that's looked like over the years. Jon, you've been doing this longer than me.
Just an age thing.
But yeah, we get brought in at an earlier role now, given that these liability managements are obviously situations where finance counsel or capital markets counsel will come help out on how to document the actual materials themselves and the financing itself. But there's other issues you need to look at, right, in terms of things getting litigated, what that looks like in a downside case or in a Chapter 11 case, and making sure that we're being thoughtful and holistic about what the approach is at the time that the financing is being done. So I think, at least from our role, which is mostly on the company side role at Latham, we're very focused on just making sure that we come in early and it's being done the right way.
Very cool.
He was supposed to say what he thought about me, wasn't he?
Oh, yeah,
that for the end.
Okay. We'll see how this goes. We'll think about it.
All good. I'm good.
But yeah, no, that's an interesting point that, you guys have been doing this for a long time. And I think when I first met you, liability management, and specifically the term like LME, was not really used. It was sort of just out of court or in court. In your opinion, when did that sort of become like the hot topic where there was its own terminology of up tiers and drop downs? When did that start?
I mean, I think it started, obviously it started with J. Crew and that kind of progeny. And not to talk about people not at Latham, but, Dave Nemesek, you cannot have a conversation about LME without talking about Dave. And I think he really did revolutionize that whole part of the restructuring industry. And, as with anything else, when you do more and more of it, people like to come up with little names and, initials for things. And so that is it. And now everybody in our world knows about it. Although if you leave our world, and you sit with friends and you talk about liability management, they have zero idea what that means. They all have their own ideas of that. So you have to explain it.
And when you try to explain it, you get a lot of very weird looks.
They're just like, why do you even do this stuff? It doesn't even make sense.
You're just
to
like,
us.
you just move the collateral elsewhere. It's
right,
fine.
Exactly.
Everybody agrees. It's okay.
Although that's not really what we're seeing much more in the LME space. Although we are seeing a lot more litigation.
Yeah.
Yeah, I think, look, it's funny, I feel like the way people view us, they would call us bankruptcy lawyers at one point, and then restructuring. Now we have special situations. Now we have liability management. It all just means, I think, getting to what you're actually doing earlier with the mindset that there might be litigation or there might be a Chapter 11 down the road. And the idea is that I think, as more public companies, as more sponsors are more willing to do this, even in the face of litigation or certain decisions that have come down, you're probably going to see it more and more. And the reality is, the sort of practice group is expanding for us to come in earlier and earlier, especially whether it's a communications advisor, financial advisor, legal advisor, banker. You're starting to see that happen earlier and earlier.
Yeah, and I think one of the things you just brought up, George, at the end of the day, it's all just about capital structures, right? And so can you fix a capital structure, or can you set it up to buy yourself more time to try to fix the operations or grow into the capital structure? And I think with LMEs and all the private credit that's out there and just the different mindset of the creditors. And, when I started, not when I started my practicing, but call it maybe when George joined us at Kirkland, you had those loan to own, hedge funds that were focused on how do we find a company where the balance sheet doesn't work for it, but it's a good company. We'll go in, we'll buy the debt at a discount, we'll convert it to equity, we'll own it. That seems to have gone away. You don't see a lot of that anymore. Now it's much more, are we going to have an issue in a couple of years? How do we go extend the runway? How do we bring in some new liquidity? How do we give the company discount? How do we get rid of all the bad things in the credit agreement that the company can do to us so we don't have to worry about that anymore, and let's see if it works or not?
Yeah, and especially on the loan to own piece, because you're seeing a lot of, we do a astronomical amount of private credit at Latham, and especially on the credit side, you're seeing a lot of credit funds that are actually out there with sponsors, with public companies wanting to be helpful, wanting to be part of the solution. At the end of the day, in a downside case, they want to protect their investment and what they put in, but they're not coming at it like loan to own. They're coming at it like, I want to be part of the solution. I want the economics to make sense. I obviously, they want to make money on it, clearly, but you're seeing more solutions because you're seeing a lot more private credit funders willing to be more creative side by side with the sponsors, with the public companies.
And I think one thing we're also seeing with the explosion of LME, but also now we're starting to see some more Chapter 11 cases that are picking up, but we're seeing all these firms now jumping in and saying we need to do things differently. So if you look at Latham, bringing over, the Weil Gottschall team, bringing over, you just brought in a new liability management person from Wachtell.
Yeah.
So while the market evolved, now we're also seeing firms, right? So you're seeing, Latham, you're seeing Milbank, right? With moves, like people are starting to make moves, but they're making it around LME. You just saw that Weil actually after the move from Weil to Latham, the Weil team that's left, they just brought over a, senior, LME star to jump into
and like
it.
you said, your firm also has like its own special LME group.
Yes.
And so what are the unique challenges do you that face that group and how they create a communication strategy? Is there anything special?
Yeah, what we find is the sponsors, and it depends on the sponsor, but sponsors want to make sure that what's going out into the media, right? Because that's what people are reading, and sponsors are always out fundraising and everything else, that it's accurate, right? And so getting in and speaking to the media and making sure that the media understands what's happening and making sure that the stories are accurate is really important. And you can speak to this as well. These are not simple deals, right? They're complex. So
it's also hard to find information on a lot of them. It's not like when you go into Chapter 11 and every pleading is on a docket and transparent. You have to really be able to source things correctly.
100%. And as you know, depending on where you are in the capital structure, you may have your own interest, right? So it may, so you may have a lawyer for the creditors that wants to get word out that there's something happening because they want to build their group, right? So that could get out to you and you're going to go put that out, but it's before the company wants people to really know about it. So now there's questions being asked, and then you may have lenders in that group that have their own interests. So they may be putting half the information out as opposed to all of it. So one of the things that we spend a lot of time on the LME space is helping manage the media. And I don't mean that I mean that in really educating the media to make sure, again, that the stories are right. For a lot of the sponsors, you also then have LP questions, right? So how do you explain to your LPs what's happening here, right? Especially if they're reading about things in the media. So we help with that as well. And then for the management team, they'll be on saying, okay, well, but if this gets out into the media, now you've got, employees or customers or vendors or others that are asking questions. We want to make sure that we are able to answer those questions the right way. And if you think about it, as we talked about before, when you talk to your friends about LME and they don't know what it means, well, a lot of these companies, like that's not something that management teams do every day, right? This is a specific situation. So making sure that we're working with management and making sure that they can communicate it correctly is really important. So that's really what we've focused on.
Yeah. And then George, as someone who comes to these companies at the first instance and pitches these ideas, how does that work for you? And how does having a new global head or a global chair of LMEs change what that looks like?
Yeah, it helps us a lot in terms of, obviously, the people that are now with our firm have a lot of reps and a lot of reputation, not just with sponsors and public companies, but also with credit funds. And being able to see a lot of what's been what's happened in the past. And I think you mentioned, John, before, most of the stuff that happens out there in the LME space, you don't even really see or understand because a lot of it's just private behind the scenes. And until it hits a litigation or public company, or if it gets published somehow, nobody really knows exactly how it all went down. But being able to have specific circumstances and specific examples and anecdotes as to how each different private credit party is going to, participate or play or react to certain transactions, it's good to know. And a lot of it is putting aside the reading of a document itself, which, is one thing. Understanding the market, understanding the pulse of not just the existing capital structure and CLOs, but external third parties that want to play in the space. It really is a game changer for us.
Yeah. So while we're talking about sort of the innovation of LMEs, I'd like to talk about the Better Health situation. So the background there is that a group of the companies, a majority of the first lien lenders got together and were planning to pursue an up tier. And they were planning on doing this through the open market exception to the pro rata sharing provisions. But then CERTA came out where the Fifth Circuit Appellate Court ruled, among other things, that privately negotiated transactions are not included under the open market exception. So the company and its lenders went back to the drawing board to figure out how they could still pursue this up tier. What they came up with was a way to not implicate the pro rata sharing provision at all. And the way they did that was the pro rata sharing provisions are only specific to a certain class. And the credit agreement allowed them to extend their maturities, which would put these lenders in a different class and no longer have to do pro rata sharing for everybody else. And so that's what they did. And ultimately, it seems like the groups who were left out, for the most part, ended up signing on to the transaction with worse economic terms. But I thought that was a really unique way of going about it. And I'll start with you, George. Do you think is this method the future of up tiers and LMEs? Is there something else people are working on? What do you think? What is the future here?
I think the future is that Better Health is an example of, even in the face of a Fifth Circuit decision that casts some doubt on that particular credit agreement, sponsors, law firms, bankers, funds are still willing to do LMEs. And that the reality is, I'm sure there's some mitigating of risks that you could take into account if you have that language, the open market purchase language that the advisors will look at. But at the end of the day, and Better Health is probably a good example, there are other avenues in which you can actually get to a transaction you want to get to, that both and Better Health, I think, added new money and also just allowed participation in exchange to push out maturities, right? You just use a different avenue to get there. And at the end of the day, I think that's what Better Health sort of shows us, right? That you could still get there just through a different mechanism.
And then John, from a communications perspective, we were aware of we at Ninefin were aware of the Better Health transaction. We knew that they wanted to do the open market exception, and then we knew that they pivoted. What does that look like if you were advising? How does that, where would a media company come in?
Sure.
Where would you come in?
Yeah, if we were in the middle of that transaction when, and it was going to change, we would be involved in all of those discussions so we could make sure that, again, that we're making sure an accurate story of what is happening comes out. But I think, the bigger picture to your question that you asked, George, the restructuring space is some of the smartest, most creative people like you'll ever meet. And so when you have a certain decision come down, or when you have a change in the law, whatever it might be, people are going to figure out new ways to fix capital structures, or they're going to, slightly change course to make sure that it works. And we saw that in Better Health. And I think what it really just shows is the creativity and the common sense and the smartness, if that's a word, of of our brethren in this space. But when it comes to the communications of it, it's really a matter of understanding exactly what's happening, right? So, for instance, when you talk about CERTA, you have to be able to talk about CERTA, right? You have to be able to talk about, well, what does this mean? You have to be able to talk about what Better Health means. You have to know what open market purchases mean. You need to be able to read the cases and really understand it, so you can then distill it down into those bite-sized pieces that people are going to hear about and understand. And you want to make sure, especially for the management team and for the sponsors, that what they're doing is for the best interest of the company. They're working towards that. And even the lenders, at least a lot of them are working towards that. And so you want to make sure that everybody's focused on the company as well. A lot of the times in restructurings, whether it's LME or a big Chapter 11 or something in between, the focus is so much on the actual transaction that people forget that you have a company that's either selling a good or a service and has all these employees and is continuing to work and needs to be positioned in the right way to maximize value and have success. We really focus on that brand management as well.
Yeah, I mean, our last deal, which is very public, Robert Shaw, John was our communications advisor. And to your point, the entire process had to do with what was happening in the Chapter 11. But really the focus on your end was about making sure the management team, the customers, the vendors, the employees understood every step of the way that we were going towards a solution that was getting us out. And that's really what people want to hear and understand.
And it seemed like the judge in that case also, that was what he wanted to hear. He kept coming back to the point that this is a company that has so many employees and is important to, and has a history. It seems like that's, to everyone, a focus in it.
Yeah, the good thing about when management teams or companies are in front of a Chapter 11 judge, even though they don't want to be, a lot of times Chapter 11 judges, because they see so many companies in Chapter 11 that are either suffering from a capital structure perspective or from a business perspective, they're very focused about the employees, the customers, the vendors. Those people, quantum-wise, are much more, right, in terms of the impact that it can have on them if you don't successfully reorganize or you don't successfully sell. So they are very sympathetic or empathetic to these other stakeholders. And frankly, that's what people want to hear in a situation when you're in a Chapter 11.
Yeah. So on that note, to close, I guess my final question for you is, where do you see this space going over the course? We're still very early in the year. Do we think this is a year of more violence, of more the gentler era of LMEs? Where are we going?
Well, going back to kind of what I said before, we have a number of decisions that are out right now that have either been positive, like Robert Shaw, or not positive, right? And at the end of the day, the one takeaway is they're all narrow decisions that have to do with the document that the judge was reading at the time in light of the transaction that happened. And to John's point, there are a lot of very smart restructuring and liability management people, credit finance people, capital markets people that are going to still continue to look at solutions that are not ultimately, like a Chapter 11 or restructuring. And that's going to include some version of a liability management or incremental cash raise or pushing out maturities. It's kind of a long way of saying we don't see LM going anywhere other than continuing. And it's just going to be done with the benefit and the hindsight of understanding what judges are saying about particular credit agreements in particular situations.
So I think that we are going to find ourselves incredibly busy, all of us, because
love to hear it.
There's so much uncertainty going on right now, right? So we've got 25% tariffs on, steel. We've got, tariffs on Canada and Mexico, but no, we don't, right? We've got the government, shutting down and funding stopping, right? Which goes into the economy. So We've got a Fed that doesn't, said we're going to halt lowering rates because we don't know what's happening. The amount of uncertainty that is out there and is going to continue, and we know the next year will be chaotic in many, many ways. That impacts all of these companies. It impacts how management teams plan for the future. It's going to impact how much people are going to be spending, or companies are going to be spending for different goods that are going to go into the products that they're making. It's going to matter for consumer spending and consumer sentiment. So I think we're just going to be incredibly busy. And I think that'll be a lot of LME because that is here right now to stay and is going to continue. I think we'll also see a lot more Chapter 11 cases because you're going to have companies that are just going to watch their costs go up and again, the uncertainty go up around it. And so I think it's going to be a very busy year for all of us.
Well, thank you guys on that happy note. Thank you guys so much for coming in and joining me here.
Thank you. This was great.
Thanks for having us.
You're great. You're a great interviewer. Yeah. When we hired you at Kirkland, I didn't know this was going to be in your cars, but I think you had a big career here.
Yeah, that's what I try to set the expectations low so that I could always surpass.
You surpassed them by far. So thank you.
And thanks to everyone for listening. If you have any questions or comments, please reach out to podcasts@9fin.com.